Hello and welcome to World Business Report with me, Alice Baxter. The headlines. The Olympic legacy. We've had the medal count. Now London begins the cost count. The Eurozone debt crisis hits Japan, causing the pace of growth to slow sharply. It's back to reality for most Londoners after the drama and excitement of the Olympic Games. Heathrow Airport's running a specially constructed games terminal to deal with the thousands of athletes and visitors returning home. So now that we've counted the medals, there'll be the inevitable counting of costs, likely to exceed $17 billion. Well, Nigel Cassidy looks now at the legacy plans for London 2012.
It was a once-in-a-generation showcase for the UK. With three-quarters of taxpayers' cash just spent on infrastructure, the legacy for a once-contaminated corner of East London is a slick transport system, a park, plus 11,000 proposed new homes with sporting, health and educational facilities. London learnt one lesson from Sydney, which had no master plan for its site west of the city. 12 years on, it has become a thriving sporting complex, in marked contrast to Athens, where rusting stadia show how the Olympic spirit of 2004 was lost and the economy went from bad to worse. Now, beyond inspiring a whole new generation of young sportsmen and women, the hope is that the 2012 effect would generate about £13.5 billion worth. That's $20 billion worth of new business for Britain. That investors overseas will be reminded of Britain's innovation and creativity. And certainly the chief of BP, Bob Dudley, told an Olympic investment conference that he thinks Britain can do it.
As a business, we've had many meetings that might not have otherwise been planned. Chance happenings, discussions, ideas, and business ideas have been progressed. So I'm very pleased with what's happened in London over the last 2 weeks.
One former UK government special advisor, Andrew Hammond, now with the consultancy Reputation Inc., says Britain needs a long-term post-Olympics business plan.
The lesson of the previous Olympics is that while you might have some short-term growth before the Olympics, possibly some short-term growth after the Olympics as well, you really have to come together after the Games, the public, private sectors and all different stakeholders, so that you can mobilise and create, in Britain's case, an economic team, GB, that will mirror the success of the athletes on the Olympic Park.
The next few months may show if Britain can ride the crest of its Olympic wave when its economy is still in a double-dip recession. Nigel Cassidy, BBC News, Central London.
Now, the effects of the Eurozone debt crisis are rippling across the globe. Japan's the latest economy to see its exports slow sharply as a result of it. Between April and June, the Japanese economy expanded just 0.3%, and that's much less than analysts had expected. The country's exporters were also hit by the strength of the yen, which makes goods more expensive overseas. Well, joining me live now from Tokyo is Mariko Oi. Mariko, what's behind these disappointing growth figures?
Well, sorry, Alice, I was having some difficulties hearing you, but as you say, it is a major slowdown in economic growth. But you have to remember that the growth in the first quarter was very strong. It was revised up to 5.5%. So it was inevitable that growth to slow down. But I think the most worrying sign is the slowdown in exports. It's down from 3.4% to 1.2% this quarter. And I guess you can blame Europe's debt crisis as well as a slowdown in China's economy for this, as well as, of course, the strong Japanese yen that we keep reporting, which makes the Japanese products more expensive overseas. And also another worrying sign is that the private consumption, the Bank of Japan met last week, and it held off from offering any extra support because it said that the domestic economy remains relatively strong. But today's figures are showing that it might not be holding up as well as it had hoped. And of course, last Friday, the government pushing through the hike of sales tax from 5% to 8% in 2014 and 10% in 2015. And I guess the immediate reaction from shoppers on the street was that in that case we'll stop shopping. So I guess that will be the concern that critics have of this bill.
So external forces to blame, Europe's debt crisis, sluggish growth in the US, etc. But what are policymakers inside of Japan planning to do to reverse this trend? The Bank of Japan so far refrained from loosening monetary policy, but do you think we'll now begin to see more stimulus?
Well, there's not much that the central bank can do at this stage. Of course, its interest rate has been near zero for a very, very long time, and it has been pumping in a lot of money into the market after the earthquake and the tsunami last year. And I guess part of the reason that the growth was very strong in the first quarter of this year was because of the government spending in the reconstruction from the earthquake and tsunami. So I guess we're starting to see that waning down, and there are some concerns that growth will be slowing down even more in coming months.
Okay, Mariko, many thanks for that. Mariko Oi there speaking to us from Tokyo. In other news now, hundreds of passengers have been stranded in Rome following the collapse of an Italian budget airline. Windjet suspended all flights over the weekend after the breakdown of takeover talks with Alitalia. The country's aviation authorities have set up a crisis centre to help stranded passengers at the beginning of the busiest holiday week of the year. The new chairman of Barclays has pledged to change the pay culture at the troubled bank. Sir David Walker told the Sunday Telegraph he would review the entire business and that he'll begin his search for a new chief executive within days. The former CEO, Bob Diamond, and chairman Marcus Aegis both resigned in the wake of the libel rate rigging scandal. The world's richest countries are reportedly planning an emergency summit to discuss rising food prices. The Financial Times says senior G20 and UN officials are considering their response after the worst US drought in 50 years has ruined crops and sent prices to record levels. On Friday, the US Department of Agriculture slashed its forecast for the harvest. Groupon reports second quarter results later. It's the largest and only publicly traded daily deal site out there, but it's still trying to live up to the hype surrounding its listing. Its shares have lost more than half of their value since it went public last November. Well, like companies from Facebook to Pandora, the great expectations that once surrounded the new wave of tech listings has faded. So are we experiencing tech's bust 2.0? Well, Mark Gregory reports now from New York.
Groupon is an easy way to get...
Groupon is one of many once high-flying internet companies in social media that have seen their shares crash. Facebook's stock is down 42% since going public in May. Internet group Pandora's shares are down 36%. Zynga, the social gaming firm's stock, has slumped 70%.
I think the common theme right now is that there was so much excitement and potential around these stocks last year, and now there seems to be more skepticism overall, and investors are now looking at these companies and thinking, okay, even though they showed some initial strong growth, that trajectory isn't going to continue.
The current drop in technology shares has brought back painful memories of the infamous dot-com bubble of the late 1990s. Then investors threw ludicrously large sums at unproven startups with names like Pets.com and Webvan. It may be some consolation to hear that today's internet bust is unlikely to be as serious as it was last time round.
I think to actually call the social media situation a bubble in the same way as the dot-com bust is almost an insult to a real bubble, because you look at the number of companies that went out from 1995 to 2000, thousands of companies and hundreds of IPOs, and so many of them were shellacked down to the point where they went out of business, or the stocks went to 1% or 2% of their prior highs. We're not seeing that here.
Investors here at the Nasdaq share market, home to many technology stocks, are having to relearn some expensive lessons. The internet provides new firms the chance to grow and prosper remarkably fast. The flip side is they can crash and burn just as quickly. Mark Gregory, BBC News, New York.
Quick flash of the markets now for you in Asia. As you can see, they're all down. Okay, that's it from me.